Welcome back to Investing Talk Podcast.
Today we're looking at POIT Technologies. It's a company really positioned right at the bottleneck of this whole AI boom. They're all about high-speed data transfer and the future of optical connectivity.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For POIT, the immediate energy, the excitement in the market, it's all focused on AI data center infrastructure. And we aren't just talking about some theoretical future here. We're seeing real, tangible movement.
And that movement comes in the form of a pretty significant $5 million production order they recently secured.
Yep. And that order is for their 800G optical engines. It came from a major systems integrator. And this is the key part. It's specifically for use in AI data servers.
That context is everything, isn't it? 5 million might not sound, massive in the hyperscale world, but it's real market validation.
Exactly. The fact that a major player is committing $5 million, it just signals that the demand acceleration is real. And maybe more importantly, it shows POIT's solution is actually ready for these huge high-demand AI clusters.
And the stock is, well, it's definitely mirroring that enthusiasm. We saw a spike of almost 15% after a price target hike, and then another 12% jump.
That was on the news about their 1.6T transmitter development.
Right, and the shelf filing. The point is, these aren't just random moves. They're higher highs, and they're tied directly to the AI story. The market is betting on the tech.
Oh, absolutely. The overall sentiment is undeniably bullish right now. You just have to look at the options data. Call volume is running at nearly double what's expected.
And the implied volatility.
It's way up there, over 110%. That tells you that both institutional and retail investors are making some really strong directional bets. They're getting in ahead of any execution updates because they see this as a rapid inflection point.
Okay, so that covers the recent catalysts. But for any of this to stick long-term, you need a real competitive advantage. A moat. When you look past the orders, what is POIT's true edge?
It is 100% centered on their patented optical interposer platform. This is the entire story.
Right. And for anyone who isn't deep in the language of photonics, let's unpack that. Optical interposer sounds incredibly complex.
It is, but the idea behind it actually simplifies things.
Yeah.
Think about how high-speed data components are made today. You have your electronics, the chip that does the processing, and then you have your photonics, the parts that use light to send the signal.
And you have to put them together.
Exactly. Traditionally, you make the chip, and then you have to painstakingly attach all these tiny, fragile optical parts. It's like microassembly, gluing and wiring. It's expensive, it's slow, and it's a huge barrier to scaling up.
So how does the interposer change that?
POIT's approach is just completely different. Instead of gluing components on after the fact, the optical interposer acts like a super sophisticated semiconductor motherboard.
Okay.
It allows them to integrate the photonic devices, your lasers, your modulators, directly onto the same substrate as the electronic chip. They do it using standard, large-scale semiconductor manufacturing, wafer-level fabrication.
So they're essentially printing the optical and electronic parts right next to each other.
You got it. It's a huge operational shift. You're moving from this expensive manual assembly line to a high-volume automated semiconductor process.
So what does that mean for a data center operator? What are the real-world advantages?
It translates to the holy trinity of data center needs: cost, power, and size. Because assembly is automated, manufacturing costs drop. But the big one in the age of AI is power. These GPUs are just incredibly power hungry.
Of course. Every single watt you save on data transmission is a watt you can use for actual computation.
That's the game. The interposer design drastically cuts power consumption because the signal paths are so much shorter and more efficient. And finally, because it's all on one chip-scale platform, the whole thing is much, much smaller. Super critical when you're packing thousands of these things into one data hall.
And this efficiency helps with signal integrity, right? Especially at higher speeds.
That's the key to the next generation. It's what allows them to maintain superior signal integrity at speeds like 200 gigabits per lane.
And that 200G per lane number, that's the technical detail that really matters for the next wave, isn't it? What does that mean in real terms?
Well, you combine 4 lanes running at 200G each, you get an 800G transceiver. You scale that to 8 lanes, you hit 1.6T. Right now, networks really struggle to handle 100G per lane reliably.
So this makes 1.6T feasible.
Feasible and cost-effective. It's the step you have to take to build the engines that will connect the next generation of AI chips.
And they're building actual products on this platform, like the PO8T Blazar external light source that's aimed at co-packaged optics, CPO.
Yeah, that's about moving the optics even closer to the processing chip itself. We're talking chip-to-chip AI links. They're not just optimizing the present, they're trying to define the future architecture.
It's a foundational technology. Oh. Okay. But if the tech is so good, why did we see that revenue miss last quarter? That takes us right to financial health, which is always where the risk is for a company like this.
And we have to look at those Q3 results head on. Revenue missed. It came in at what, 0.3 million versus 0.55 expected? EPS missed a bit too.
For a skeptical investor, that just screams execution risk. That scaling up this kind of complex tech is just too hard, too risky right now.
And that skepticism is fair. That Q3 miss is the anchor on the valuation right now. But you have to look at the bigger financial picture. They are running revenue light, yes, but they are absolutely cash rich.
How cash rich are we talking?
They just closed a $75 million investment back in October of 2025. And it was specifically earmarked to fund this AI growth. On top of that, they filed a $143 million shelf registration. They have no significant debt. This isn't a company that's struggling for cash.
So they're intentionally burning cash to build out.
Exactly. That explains the negative free cash flow in EBITDA. It's not from operational losses on sales. It's because they're in a heavy investment cycle.
So that negative FCF, it's a strategic choice?
It's a necessary evil right now. They're pushing every dollar into scaling up production capacity. It's a classic burn-to-grow strategy. Capture market share now. We're about positive FCF once the big volume shipments start.
Which brings us to the most important question, the production ramp. When does this all go from theory to actual material revenue?
That is the critical catalyst. The production ramp-up is targeted for the second half of 2025. That timeline is what the entire market is pricing in. If that date slips, the valuation's going to get hit hard.
And their manufacturing partner, Globetronics in Malaysia, is key to this. What kind of volume are they aiming for there?
They've stated that capacity is expected to exceed 1 million optical engines a year. 1 million, that's a hyperscale number. It shows they're not planning for small orders, they're building for the major cloud providers.
And to back that up, we need to see the partnership validation continue. Who are the key names we should be watching?
We need to see purchase orders from their existing partners start to roll in. We're talking about Celestial AI, Adtran, Mitsubishi, Luxshare, FOIT, and Lessengers. The samples for the Lessengers 1.6T transceivers, those are due in the second half of 2025. That will be another huge validation point.
Okay, let's pivot back to risk because we can't ignore the bear case here. What keeps you up at night with this one?
The primary risk remains execution and dilution. Two sides of the same coin, really. We've talked about the execution risk, the Q3 miss, the negative cash flow. Scaling this kind of tech is notoriously difficult. Any delay in that H2 2025 ramp is an immediate red flag.
And let's be blunt about the dilution risk. The shelf filing allows them to sell almost 30 million shares. Now, that $75 million raise gives them the cash they need to grow, but
issuing that many shares will absolutely put pressure on the valuation in the short term. It's a trade-off. The market is being asked to accept some short-term pain in exchange for long-term security and the ability to execute.
It's the cost of growth.
It is. And they face a lot of competition. The optics space is crowded. But this is where that moat, the optical interposer, comes in. Their manufacturing advantage is just extremely hard to replicate quickly.
So what are they doing to secure their spot beyond just 800G?
They're thinking a few moves ahead. They're building partnerships focused on the next generations. Working with Semtech on 1.6T receivers is one example. And looking even further out, they're collaborating with QCI to develop 3.2 terabit per second solutions.
So they're building a roadmap.
A roadmap to stay ahead of the curve, yeah. To ensure the interposer remains the go-to platform for future speeds.
So when it all comes down to it, what does this mean for you, the listener? We are looking at a classic high-risk, high-reward scenario. It's all built on transformative tech, and it's being driven by this just insatiable demand for AI bandwidth.
The entire investment thesis really boils down to one single point: the successful execution of that production ramp in the second half of 2025. The real results from that ramp, the actual volume numbers, that will be the entire focus of the earnings update we're expecting around March 31st, 2026.
And if they hit those targets?
If they hit those volume targets, they become an essential supplier to the world's most demanding data centers. and that could lead to some really significant growth.
The key then is to watch those operational milestones we talked about, the Globetronics capacity updates, the partner POs, and any clear volume reports for the second half of this year. That manufacturing ramp is the inflection point that will determine everything.
Absolutely. So don't miss out on tracking how this develops. Hit that follow button on your platform and subscribe to our analysis so you don't miss our next look at this space. We'll catch you next time.